Welcome to Tuesday's Commodities Corner. I'm Elaine Stenson. Brent Crude fell 2% on Monday in reaction to well-supplied markets and limited demand from European refiners, narrowing the gap between the global and US oil benchmarks. Markets are also brimming with supply, with Saudi Arabia's production little changed in November from the previous month, and OPEC producers Iraq and Iran making it clear that they have no interest in contributing to a collective cut in output should one be required next year. I'm joined on the line now by Campbell Palfrey from the Rapidan Group in Washington. Campbell, how concerned should we be about this?
Well, I think the market's been fluctuating in the past 6 months on kind of alternating bearish and bullish news, and bearish supply projections for next year, and then bullish geopolitical disruptions, and then occasional macro data. Macro's gone both ways. I don't really expect that to change in 2014. I think we're going to see a lot of the same stories. Large supply increases in Iraq and North America and Brazil are certainly bearish. I think the key question, though, is going to be how much of the North American production can make it to global markets. Of the large supply increases projected for 2014, North America's, depending on whose projections you look at, is anywhere from a half to two-thirds of the expected total supply increases. What I don't think is discounted as much in the market right now is the extent to which a lot of that is bottled up in North America. There's been a lot of discussion in the past year, and certainly a lot of trading activity around the WTI Brent spread, with Cushing inventories, through last year, blowing out. With expectations that, as infrastructure gets built from Cushing to the Gulf Coast, I think the expectation has been that those spreads are going to come in. But I think what we're starting to learn, and what markets are seeing, and certainly traders in the Gulf Coast are seeing, is that what we're really doing is we're kind of moving that. If we had a constraint at Cushing last year in 2013, I think what we're looking at going forward is a constraint along the Gulf Coast as refiners become saturated there, and they can't with the export restrictions on U.S. crude. A lot of that oil that was stuck at Cushing is now going to be stuck at refineries and storage along the Gulf Coast. So I think to a great extent next year, Brent prices are going to depend on how much of that North American supply can actually make it out in the form of refined products, or what volume of imports to North America can be backed out by those production increases here. But I think that's a story that's kind of developing still.
The global macroeconomic situation, which led to increased oil demand, helped cap the upside in oil prices amid a range of supply problems through 2011 and 2012. But analysts are saying that the tide seems to be turning. Demand is making a comeback and could very well surprise to the upside. How would you respond to this?
I think there's certainly been some optimism of late on bullish demand surprises. Again, I think I'm a little bit wary of bullish macro forecasts for 2014. I think if you look back to the past 2 years, we've seen consistent downward revisions to global GDP, and the current trajectory for 2014 global GDP, the revisions have been going down since November of last year, according to the IMF. I think I saw over the weekend that Brazil and China have released down revisions to their GDP expectations for next year. I don't think we're over the global macro doldrums yet, and I think while demand is still going to be, I don't expect a significant demand change from what we've seen in the past year. That being said, I think that the oil intensity of GDP growth is somewhat stronger than many people think. I think that current GDP growth as we've seen in the past couple of years is sufficient to support prices next year. I think overall next year we see year over year a fairly balanced market. I think prices ranging next year in the 108 to 110 range isn't out of the question. Is what we look to. Is kind of what we expect.
Finally, Campbell, Colombian state-owned oil company Ecopetrol said they have discovered an estimated 1.3 billion barrels of oil in Colombia, and that about a tenth of it was likely to be recoverable. The announcement is an important addition to the diminishing reserves the country has been urgently trying to boost. Colombian production is quite small relative to global supply and demand. Is this find going to have much of an impact?
I think it could have an impact for Colombia. They're heavily dependent on their crude exports for revenue. Colombia produces about 1 million barrels a day, so the expected addition of about 20 to 50,000 barrels a day is what the find is expected to produce, is helpful for Colombia in the medium term, but not a game changer. I don't think for global crude balances. I think every little bit helps on the margin, but I don't think it's going to be something that people pay too much attention to. I think global markets next year are going to be more focused on supply developments in the U.S. As I mentioned before, how much of the U.S. supply can make it out to global markets to affect Brent prices, and then the additional supply increases in Iraq and the Sudans and Brazil are going to get a lot more attention than Colombia.
Okay, Campbell, thank you for that, and thank you for joining me on the line today. And that's all from Commodities Corner for today, but Thomas Taplin will be back with more on Thursday, so do check back for that. Bye for now.